Welcome to our guide on dollar cost averaging, an essential investment strategy. In this video, we'll break down what it is, how it works, and why it can be beneficial for your financial planning. Dollar cost averaging involves investing a fixed amount of money at regular intervals, regardless of market conditions. This method can reduce the psychological impact of market volatility and encourage a disciplined investment approach. Over time, this strategy can potentially lower your average cost per share, making it an effective tool for long term wealth building. In the upcoming segments, we will dive into the basics, benefits, and how to set up your very own dollar cost averaging plan. We'll tackle common misconceptions and share real life examples to illustrate its effectiveness. Whether you're a novice investor or refining your strategy, stay tuned as we explore the ins and outs of dollar cost averaging. As we move forward, you'll see just how straightforward and impactful this investment method can be. Welcome to our step-by-step guide on dollar cost averaging, an essential investment strategy for both beginners and intermediate investors. In this first segment, we'll dive into the basics. Dollar cost averaging involves investing a fixed amount of money at regular intervals, regardless of market conditions. This simple yet powerful strategy helps you buy more shares when prices are low and fewer when prices are high, smoothing out the impact of market volatility over time. Imagine setting aside a consistent amount, say $100, every month. When the market is down, your $100 buys more shares, and when the market is high, it buys fewer shares. Over the long run, this method can lead to a lower average cost per share compared to trying to time the market. One of the main advantages is that it removes the emotional aspect of investing. By committing to a fixed investment schedule, you reduce the temptation to make impulsive decisions based on short-term market movements. This disciplined approach is especially beneficial during periods of market turbulence. Dollar cost averaging is versatile, applicable to various investment vehicles like mutual funds, stocks, and ETFs. The core principle remains the same: consistent, regular investments without the stress of market timing. In the next segment, we'll explore specific advantages of this strategy and enhance your overall investment plan. In this segment, we're diving into the key benefits of dollar cost averaging. One of the main advantages is its ability to reduce the impact of market volatility. By investing consistently over time, you spread out your purchases across various market conditions. This approach encourages disciplined investing, ensuring that you avoid the pitfalls of market timing and emotional decision-making. Another significant benefit is the potential for a lower average cost per share. By purchasing more shares when prices are low and fewer when they are high, you smooth out the cost of your investments over time. This not only stabilizes your portfolio, but also helps maximize your returns in the long run. Dollar cost averaging simplifies the investment process, making it accessible and manageable for investors at any level. As we move forward, we'll explore how to set up your investment plan to take full advantage of this strategy. In step 3, we lay the groundwork for setting up your dollar cost averaging plan, an essential aspect of your investment journey. First, determine how much you can regularly invest. It doesn't have to be a large sum. What matters is consistency. Once you've decided on an amount, choose your investment intervals. Whether you prefer monthly, bi-weekly, or weekly contributions, the key is to stick to a regular schedule. Next, select the investment vehicles that best align with your financial goals. Are you looking at individual stocks, mutual funds, or ETFs? Each has its own set of benefits and potential risks, so make sure your choices reflect your long-term objectives. By breaking down this process into manageable steps, you bring structure and predictability to your investing strategy. This approach not only ensures that you're consistently putting money into the market, but also helps you avoid the pitfalls of market timing. You invest systematically, reducing the emotional highs and lows that come with market fluctuations. Remember, the goal is simplicity and consistency. You're building a plan that works for you, one that you can stick with over the long term. As we move forward, you'll see how addressing common misconceptions can further solidify your understanding and confidence in dollar cost averaging. Stay tuned as we debunk the myths that might be holding you back. There are several misconceptions about dollar cost averaging that often mislead potential investors. Some believe it's only designed for beginners, while others think it requires large sums of money to be effective. Many also assume it isn't the best strategy in volatile markets. Let's take a moment to debunk these myths. First, dollar cost averaging can benefit investors of all experience levels. It's not just for beginners. Second, you don't need a lot of money to get started. Even small regular investments can grow significantly over time. Lastly, it's particularly effective in volatile markets because it spreads out your investments, reducing the impact of market fluctuations. As we move forward, you'll see real-life examples that demonstrate the effectiveness of dollar cost averaging. Now that we've debunked some common misconceptions, let's look at real-life examples that illustrate why dollar cost averaging is a powerful strategy. Take a long-term investment scenario. By consistently investing the same amount, you smooth out market fluctuations, reducing the impact of short-term volatility. This ensures you buy shares at various price points, averaging out their cost over time. Next, consider a market downturn. When stock prices drop, your fixed investment amount buys more shares than at higher prices. This means that when the market recovers, you stand to benefit significantly from the lower average share price. Finally, in a consistently growing market, dollar cost averaging helps maintain disciplined investing. By regularly contributing, you avoid the temptation to time the market, which can lead to poor investment decisions based on short-term fluctuations. These examples demonstrate the versatility and effectiveness of dollar cost averaging, providing a practical approach to investing that mitigates risk and harnesses market opportunities. As we move forward, you'll see how to monitor and adjust your plan to ensure it remains aligned with your financial goals and current market conditions. In Step 6, we emphasize the ongoing process necessary for successful investing, monitoring and adjusting your plan. Regularly review your investments to ensure they still align with your financial goals. Stay adaptable and ready to make changes based on market trends and personal milestones. Staying informed about market developments is crucial. It empowers you to make savvy investment decisions. By remaining proactive and vigilant, you can navigate the complexities of the market with greater confidence and precision. Keep fine-tuning your strategy to maximize your investment potential. As we conclude, let's recap the key takeaways and what's next. To recap, dollar cost averaging is a powerful investment strategy that can help you navigate market volatility and build wealth over time. Throughout the video, we've explored the basics, highlighted key benefits, and debunked common myths. We've also shown real-life examples and discussed how to set up and monitor your investment plan. Now, it's your turn to take action. Start your investment journey with dollar cost averaging today and take the first step towards financial stability and growth. And while you're here, don't forget to subscribe to our channel for more insightful financial tips and advice. Together, we can make your investment goals a reality.